Hi, this is John Prasinos, Editorial Director of Investing Daily with a video update for Tuesday, July 7. Today's topic concerns a powerful investing tool that can turbocharge your retirement planning. It's called tactical asset allocation. Rather than try to pinpoint individual companies and industries you think will pop when the coronavirus pandemic ends, exchange-traded funds, ETFs, are a potent means to that end. The goal of a tactical asset allocation strategy is to seize on fast-moving trends or to take advantage of any short-term view of the markets. ETFs first burst upon the scene in 1993 and they've become wildly popular. There are now more than 2,000 ETFs tracking just about any imaginable asset. Tactical asset allocation doesn't involve day trading. So it's not day trading. It's temporarily changing your mix of investments predicated on trends that you expect to unfold over the next 3 months to a year. Once you've decided which industry to target, ETFs are a great way to accomplish your goal. You could, of course, buy individual stocks or bonds in the sector of the market that you think will perform well over the short term. That's still generally a good strategy. We're not saying that you get rid of stock picking altogether, but there's a drawback: lack of diversification. If you buy just one stock in the sector you expect to outperform, you shoulder the risk of being correct about the sector, but unlucky with that specific stock. If you decide to seek diversification by selecting a basket of individual company stocks, commission costs can quickly escalate. Using an ETF can be a simpler, safer, and cheaper way to spread that risk out among several different companies. It's a strategy worth considering. Mutual funds can accomplish tactical asset allocation, but your choices are limited and you'll incur higher management fees. If you have an investment goal, chances are good that an ETF exists that matches that idea. Take a look at the following infographic. Make sure you read the ETF description and mission statement. Look at the prospectus and examine the top 10 holdings. The ETF's portfolio holdings should correspond with what you expect to happen in the market. Scrutinize the expense ratio. For passive ETFs, the typical ratio is about 0.2%. That's lower than the average expense ratio for actively managed mutual funds, which hovers between 0.5% and 1.0% and typically goes no higher than 2.5%, although some fund ratios have gone higher. Don't overlook liquidity either. Several new ETFs come to market each month, and it can take time for them to create market awareness and build up enough volume to be reliably tradable. If you buy an ETF that lacks sufficient liquidity, your overall cost could be higher than you anticipate due to bid-ask spreads, or, in the worst-case scenario, you might not be able to sell your shares when you want. Do you have a well-reasoned expectation of what will occur in the markets? Just as you can buy or sell stocks at any time during the trading day when the market is open, you can also buy or sell ETFs in exactly the same manner. Consequently, you can pursue your investment theme and tactically change the asset structure of your portfolio with the press of a button. 3 sectors that look really great right now, that make a lot of sense during the coronavirus pandemic: utilities, consumer staples, and healthcare. They provide essential services that people need regardless of economic ups and downs. Well, there you have it. If you have any comments or questions, send your emails to mailbag@investingdaily.com. In the meantime, stay invested, but please stay safe. Thank you.